All right, good morning. We're starting to see a few people shuffle in here. So as we get everyone in, I'll go ahead and give us the quick intro here. Good morning, and thank you for joining us for today's discussion on decoding the downturn, taking a look inside the trucking market. My name is Jacob Eischen, and I'm the marketing manager here at Optum. I'll be running and producing today's live stream as we take a look inside the industry and behind the market. So I'm happy to be joined by our moderator and FreightWaves Director of Market Intelligence, Zach Strickland, FreightWaves Enterprise Trucking Carrier Expert, Thomas Wasson, Arrive Logistics VP of Market Intelligence, David Spencer, and DAT Principal Analyst, Dean Croak. Before I hand the conversation over to Zach, who will be leading the charge today, if you have any questions, feel free to drop them into the Q&A section, and at the end, Zach will come back around to those. So without further delay, Zach, it's yours.
Thank you, Jacob, and thanks to everybody for tuning in or watching this on recording. Zach Strickland, Head of Market Intelligence at FreightWaves. I get the wonderful job of being the moderator today to get to ask this panel questions about this market environment that we're in. And I think a great place to start, and I'm going to go from left to right on my screen. So we'll start with Dean. I'm going to pose this one to you first, Dean. Basically, let's set the context. How does this market compare to other previous markets? I think we've been in, obviously, I think everybody would agree it's a very loose environment from a transportation service provider situation. How does this one stack up with some of the ones that you've seen in the past?
Very different, Zach. First of all, so excited to be back with you guys again, with David and you guys. It's just good to be on the show chatting about the freight market. I always feel I learn a lot from listening to you guys. So I am going to ask you some questions, even though you're the moderator.
Oh, okay.
So this is a really different freight market, right? This is not like anything I've seen, and there's a few reasons. One is we're still feeling the after effects of what started 4 years ago. So that upset a lot of supply chains, a lot of ocean routings, a lot of location of warehouses. There's just been so many things change on the supply chain side. But I think the biggest difference, notwithstanding the fact we've got very soft freight demand and some of the things that we normally would look for as indicators of elevated freight demand aren't there in this sort of spring season that we talk about. I remember I learned a lot from you about, we talk about at FreightWaves, the spring replenishment season. So I started to watch, loads of garden mulch coming out of Maine into Home Depot parking lots. And that was that to me was the first thing I noticed this year. It was earlier because there was a very different kind of weather, but then nothing much really happened after that from a demand perspective. Seeing a little bit of a trigger on the freight side, demand side with produce. But to answer the question specific, the reason this one's different is on the supply side. Now, I know that supply doesn't necessarily trigger, help flip a market in terms of supply exiting the market. But there's one thing that I think everybody underestimated in the last couple of years, and that was how much money carriers made. So remember, this is coming from a truck guy that owns a truck that still pays for tires and fuel and diesel and talks to truckers every day, right? So I got a good sense about how well off they are, despite all the grumblings, right? This is a group that would boo their own grandmother, right? They always, the glass is always half empty, right? Even when they're doing well, things aren't so good, right? So put that filter on this. I'll give you an example of a friend of mine, Sammy, and he was running during the pandemic, joined in 2020, late 2020, bought a T2000 Kenworth, I think, a used truck, reefer trailer. He banked during 2021 $100,000 in profit, and he's still got every cent of it today. So he joined the market, paid off his truck, and is still sitting very flush. Now, if I said to you average operating costs today are $1.80 a mile for a long haul spot market carrier, he's sitting at about $1.50 because you can take out 30 cents a mile for finance. So what happened during the pandemic? And again, this is a theory I'd love you guys to challenge me on, but anecdotally, I heard a lot of carriers made a lot of money. We saw it on the earnings calls of the large TLs, right? Record levels of income, incredible revenue streams, lots of profit. Owner operators were the same during that period. And I think what we've now got in the market are a lot more independents and owner operators that are a lot more cashed up and can ride out this soft market longer. Now, it doesn't mean that runway is infinite. We will get to an endpoint at some stage, but a lot of us have talked about how slow capacity is bleeding off in the industry. Anecdotally, I can point to carriers who are, and this is an interesting theory also, is I feel like a lot more independents have become like the Landstar BCO, non-force dispatch guy. I feel like there's a lot more ICs outside of the Landstar network behaving the same way because they can afford to be more selective. And that's adding a lot more capacity into it's keeping capacity in the market, it's keeping the market soft, and we're not really seeing that inflection point. So to answer the question, I think this market cycle is different because of the incredible profitable period that we saw from the middle of when PPP loans ended in July of 20 to the end of 2021 was the most profitable period I've seen in decades.
Yeah, I think we do underestimate. I agree with you almost entirely there that we do underestimate just how much money, how much wealth was blown into the economy. 4.6 trillion, I think, is a number that I've heard.
Right.
That like we don't have a good perspective on how much money that is, and especially from the transportation sector.
Right.
Like there's so much of it. So I want to turn to David here and get a little bit different perspective on this market environment from a 3PL side. So David, tell me, how does this market from a 3PL perspective compare to previous ones in the past? Is there something that kind of an intermediary can do to kind of weather this storm differently than a asset-based carrier?
Yeah, well, no, I appreciate the opportunity to join the call today, first off, and Dean, a tough act to follow there. Your wealth of knowledge on all things carrier operating costs and what's going on from the carrier point of view. Certainly from a intermediary perspective, or even interactions with shippers. Hopefully, that's a perspective I can help bring to the conversation today as well. I think one of the areas where we've certainly seen a ramp up of sophistication on the shipper side is in how they manage their freight and work with rates. The introduction of new technologies such as spot APIs, that's certainly changed the game and given shippers new strategies or new ways to sort of think through how they procure transportation, right? And so it helps them find the bottom, stay on the bottom. They work with large carriers or providers who handle the high volume commitments for them, and they're able to kind of go out on low volume, or when they see those failures, to maybe number 2 or number 3 in the routing guide, where they have these spot APIs and they let brokers kind of compete against each other or other carriers. And that's helped keep rates at a floor. I mean, they've been at a floor for at least a year at this point. I think, yes, some seasonal up and down, but certainly those types of behaviors from the shipper side of things are something that we're seeing in this environment that we didn't necessarily see on the backside of other inflationary cycles in prior instances. Certainly the capacity side trends. You talked about profitability, Dean, the equipment availability. We definitely think shippers invested heavily in private fleets after what they saw, the advantages that offered them through the last upcycle. Maybe that's taken them a little bit longer to realize here that maybe not the best investment, and it's hard for those fleets to be profitable. We're definitely seeing an uptick in interest in helping fill some of those empty miles for these fleets. All of these things have really contributed to the depth of this, where rates have fallen, and the duration as well from our perspective.
I'd like to kind of follow up on that. Is there any advice that you're currently giving the shipping companies, or just companies in general, about their transportation to like moving forward? Because I think we all on this panel probably agree this is no more sustainable than the environment during the pandemic, and things are probably going to shift. Is there any forward-looking advice that you're giving?
This is always the toughest part of the cycle, right? When you're at
Yeah.
the bottom and not exactly sure when, that upcycle is going to kick off. We largely believe that there needs to be some sort of catalyst to really, spark a true disruption to routing guides. But we're at the bottom. We've been at the bottom. I think we're just mostly talking through what some of the indicators are that you should be watching. Everybody's network is going to look different, right? If you've gone out and you put a lot of your eggs in the cheap rate environment, on your contract side, your rates are more at risk of disruption than the larger market. Tighten up your carrier network a bit. Things you can be doing to prepare for an upcycle. Well, maybe understand who the carriers are that have stuck with you that aren't going to give that freight back if things change. Have a good depth chart built up. Like I said, though, it's really difficult at this point in the cycle to predict when that upcycle will come. Just be prepared to react quickly and, go from there, right? You can do things like extend your pricing terms to try and lock in, commitments through a potential upswing. Certain providers are going to be better equipped and more willing to hang on to those commitments for you, and try and sort through who those people are going to be.
Yeah, it is a challenge. I think everybody always looks for those forecasts and they want it done with precision. And historically speaking, we've never been able to predict the catalyst, as you call it, with any level of precision. We know that it's coming, and we kind of have a sense of the range, but we've never been able to say, here it is, September 30th. That'll be the day. I think I even jokingly gave out a prediction of November 8th just recently, and it was a very tongue-in-cheek prediction, but hopefully nobody holds me accountable to that. So I'm going to turn to Thomas here. My fellow freightwaves are here. And, from the large fleet standpoint, is there any sign or any stuff you're looking at right now that gives you an inclination that this is something that the larger carriers and fleets have, been able to weather better? Are they getting to the end of this? Dean really talked about it from the owner operator standpoint there. I think the smaller carriers, obviously, that's where a lot of the capacity grows in the market when we see this capacity growth. But a lot of the capacity actually exits through the large carrier, which I find fascinating due to consolidation. Is there anything that you're watching there that's giving you a sign that maybe this market is changing or shifting?
Well, I always like to, looking at the earnings calls and the talks from large fleets. I came from a large fleet. I cut my teeth in it. When they say things, think of it like trying to diagnose your cat. Like if my cat doesn't feel well, he just randomly hides. But the problem is large fleets don't really like to say things because it can turn around and bite them. So the big thing that was for me, it's very subtle with them. Q1 bids were a surprise. That was the first thing that came out. JB Hunt, Knight Swift start talking about we were caught off guard. Then we start hearing the development. We're not going to take rate concessions, almost like a warning sign. Then you look at Martin, you look at Heartland, you look at really good operators, and you can see that the challenge is they're trying to signal a quarter early to customers, be wary. I'm making my list and checking it twice because like David talked about, when it comes to the shipper who wants to try and lock in those commitments, we have a situation where it could quickly turn into paper rates. That is one challenge. To the equipment, I've heard anecdotally from some carriers that if their allotments were messed up, when you say you're buying too high, well, when new Class 8s were too expensive, just like with the used ones, some fleets made mistakes in terms of financing. Now, this shows up in the numbers, so it's hard to see outright, but the large fleets that will fail, and I've heard anecdotally there's a few that are struggling financially, is they messed up their allocation. When expensive units, Class A's were high, they took 100% instead of maybe scaling back 50. Little changes like that. Look at the average age of tractors and trailers. And then finally, there's just competition from other fleets and customers in terms of private fleets. We've seen a large part of growth of private fleets coming out of the tail end in the for-hire, so we're getting cannibalized there. Brokerages that are technologically savvy are getting larger pieces of the contract pie. That's the second challenge we're running into. So now I've got challenges from owner operators who have the technology to work with these tech savvy brokers. And then finally, sustainability is a big issue. We saw some earnings calls, the EV talks, emissions. So it's hard right now to be a large trucking company. My biggest thing I've noticed is they all want to get out of trucking. If you noticed on the calls, finally, look at Werner and them. We're going back to dedicated. We're going to go pretend to be in managed transportation. We got to get away from OTR. And then the others like your JB Hunt, who's mostly intermodal right now. So be careful because, they messed up getting international containers versus rail versus domestic. So they thought it was going to be good when domestic was flat and international was the one getting the action. So it's a hard time being a large trucking company because you feel like everything you're doing is just wrong because it's always, the carriers, the small fleet and owner operators got really hit hard for the past like year. And it took large fleets about 6 months to catch that funk. And now that they're in the funk, the problem is they know they're going to be in it for longer. So it's one of those things that we just got to keep looking and listening, listen for the whispers, because right now it said a whole lot in Q1, and we should expect to see as we move into the midpoint of the year if it's going to get better or worse. Because that's my biggest thing to watch is in the contract space, we have a lot of movement and a lot of kinetic energy that can move really fast if they start to see an opening.
Yeah, I kind of want to ask you a quick question. And then I know, Dean, you have a question that you want to pose. And I think this is a good segue. So Thomas, recent earnings reports, Knight Swift basically said, hey, we're no longer taking on business that's below what we deem acceptable. This is easy to say, and I'd like to get your take here on the fact that spot rates are generally pretty low, and in a lot of cases they're below contract in a lot of spots of the country. Is this a strategy that you see from the larger fleets? Like, do you think this is a viable strategy? And also, do you think that this is something that they're actually going to be able to do, considering, there's so much slack in their networks?
High risk, high reward strategy, but it also tells you that if they're, and that's not the only one, I've heard 3 or 4 of them mention increased spot exposure. One mentioned reducing reliance on brokers. You can do that through other things, but yes, it's a very rare thing. You'd really like that 85, 90% contracted because you get paid more on the aggregate. You don't want to really dip into that spot unless you're doing one of 2 things. So if I put my pricing hat on, I'm thinking, well, they're rolling the dice. So they know that Q1 was so bad that we're going to put a chunk aside. We're going to dip into the spot market. So that could be the extra pressure we're seeing. We're just going to hope that it goes slightly up into Q2, but we're also evaluating our mix and stuff. So I do think this is a pivotal point to watch. We're not going to know the answer yet, but it's rare to see them go into that and they're dipping into that. So it does seem to be that we're hoping that because they do their bids, your customer mix may refresh a quarter of it, depending upon your rolling averages. Every quarter you have RFPs that you're constantly cycling through. They may be doing that thing where maybe the customer they really want is a Q2 or a Q3. They're going to try to hit the brakes, dig their heels in. We just don't know if it's going to pay off.
All right, Dean. I know you got a question. Let's hear it.
I'm just so happy that with the driver shortage is no longer a problem to solve.
Oh yes, it is. It's always a problem.
that old chestnut will come around shortly. But so, a question for David. As you were sort of talking about the market and bids, David, one of the things we heard on our shipper side is this last market cycle. So I'll go back to last year. We were hearing, and it's sort of the first time we'd heard about shippers in the main, like most of them strategically buying in the spot market. So they were working deeper with their incumbents where 80% of their volume is typically on 20% of the lanes. So they were going deep with incumbents there. But rather than wait for that panic transactional buy when there's a routing guide failure, what we were being told, and I want to get your opinion on this, that shippers were going deeper with non-asset 3PLs, brokers to build in spot buy capacity so they could manage the cost of the spot market buy when it arose. So it's almost like a carve out of the routing guide between, we're not going to put low volume lanes into the routing guide because they'll just generate a failure, in most cases, and we'll just go deep with all of our incumbents on the high volume lanes. Is that something you saw or have seen this year?
Yeah, I mean, certainly. I mean, you look at what even is on the RFP, and most of that low volume stuff isn't even on there anymore. You just get access to that as being a provider for these shippers, through the spot portal, right, or through these rate APIs and spot automated pricing opportunities, and really, it's been found that it's better for both parties, right? As an intermediary, we're not committing to moving 3 loads annually and not having any idea when that's going to come, and maybe they all come on one day, and it might be Wednesday of DOT week, right, or something like that, where it's very difficult to provide a price for a long-term commitment on very low volume, right? As an intermediary, you're working with carriers very much like a shipper would, right? We have these relationships. We manage capacity at scale. We're providing committed capacity to shipper lanes. We're happy to play in that space. And as Thomas referenced, right, 3PLs are getting increased market share of these contract opportunities because of our ability to work with these larger network of carriers in that way, find that capacity and source it. But, we're also a nice outlet for, and a shipper's find, they don't want to deal with rejections on that low volume freight. They'd rather just, price it out to the market and have the pipeline set up to handle that when they need it.
It has to help your carrier, private carrier network, right? Because you're building in a lot more density and lead time.
Yeah, if you can kind of identify the patterns there, and make sense of it. But it definitely is helpful for our network for sure.
Got it.
Yeah, we actually got a question coming in, David, that asking to expand on your involvement with private fleets and basically them using 3PLs to help expand their networks. Are you seeing that demand grow?
Yeah, that's a very interesting trend as of late. Something over I would say, even the last couple of months here, and even anecdotes from we had, myself personally, not necessarily talking to private fleets, but we have a team, a strategic capacity team that is working almost exclusively with private fleets, and how we can help move that, capacity for them, utilize that underutilized capacity, they fill empty miles, et cetera. We're definitely getting a lot more appetite for getting involved with 3PLs, where in the past they've been hesitant because of, what potential challenges that could, pose to them and not getting their trucks back to their customers, on time, right? And that kind of thing. But definitely increased, appetite to work with 3PLs. And a couple of our reps who were at a conference last week, they were specifically talking about, a little bit more grumblings, the grumblings Dean was talking about, right? Of the toughness for it out there. So private fleets are struggling as well.
Interesting. And we also got another question, Dean, for you about, could you expand on what you mean by an owner operator operating more like a Landstar?
Yeah, so to be clear, owner operator in this context is an independent contractor, not a leased on owner operator that's, say, working for a large TL. In this case, so the Landstar owner operator is typically it's a non-forced dispatch, so they're more selective about their loads. Think about someone that works 8 months on, 4 months off, has their own truck and trailer, very low levels of debt, can be very choosy about the lanes they run and when they run and for what rate per mile they run. So if you looked at the Landstar BCO count from their earnings calls, it's back down to 2017 levels after I think roughly it was like maybe, if it was 10,000 at the peak of the pandemic, it's 7,000 now or something like that. I can't recall the exact numbers, but those carriers come into the market and go out of the market depending on how profitable the market is. So it's about the ability to be choosy. So they're much more choosy about when they work and where and for how much. And that's got a lot to do with amount of equity in the business, how skilled they are, how good their equipment is. And what I found during the pandemic is a lot more of my friends and owner operators behaving like that. And they're still behaving like that today. And I'm ribbing them on social media saying, get off the beach and get to work. Now, I'm not joking. There's guys out there that they're posting pictures in Cancun. I'm thinking, what the heck are you doing there? Well, we're spending more time taking our families on vacations, which is exactly what they should do. But it's because they can do that, which is that's not what you'd normally expect from a freight market where you've only been in the industry a few years. So to answer the question, I think we're seeing a lot more independent contractors outside of the Landstar network behave a lot like the no force dispatch Landstar model that we're all used to over the last few decades.
I want to add on that, if I can, Zach, real quick. The technology aspect is allowing that. Imagine the Uber Freights, the Convoys. We talked about their growth since 17, but I do think Dean's hitting a point where there is a behavioral shift, even in recruiting drivers, where I spoke with somebody that it's easy to find drivers, but half of them still aren't showing up to orientation. And if it takes 1,000 to get 5 and you're only getting 3 or 2, there is a transactional shift, and that's what I've noticed is when you're talking your theory longer. Why has this lasted for longer than typical other cycles? I think the technology component it's for brokerages and carriers have gotten to the point where when I was at US Express, the tech in the early 2000s was pretty sophisticated, but now it's everyone's using this. So the advantage has gone away for large fleets. And I think that's part of the thing we're seeing is everyone can operate like a large fleet now. So they're being choosier and you're not seeing that typical cycle of, dip.
Yep. That's a good point.
That's a great point. I kind of want to ask David, like from your perspective, what kind of role do you think technology is playing in this current market environment for, tight or loose? Have we seen a significant shift there that we're just kind of missing?
I kind of alluded to it earlier, right? I think it's definitely giving shippers more ability to get creative with the way that they're managing their freight. It's certainly giving them more. They're utilizing it as part of their scorecarding right now as well, right? Which carriers are providing the best services? The tracking expectations are high. From a technology perspective, I guess not any more than what I've kind of already alluded to, right? In terms of accessing capacity in the spot market, right? And just overall integrated pricing setups and things like that. So, nothing more to really add on that front.
Yeah, I mean, well, can I pose this to anybody on the panel here? Do we think that technology has now become a necessity to operate in the market?
I'll have a crack at that, and I think absolutely. So again, like going back to the pandemic, friends of mine were, buying a truck, had no experience whatsoever,
right?
And they're showing me on an app on their iPhone the entire freight market,
right?
And it's like, really, and of course you don't have to spend 20 years making mistakes and finding out where not to go and how much to haul freight for because it's all on an app these days. So I think it feels like the growth in technology has been exponential over the years and that we're just seeing so much more transparency where a new entrant can come in and avail themselves of all this market intelligence. Heck, the pandemic spawned all of these podcasts that we do. Like, and you can drive down the road and hear from experts from every part of the supply chain on how to run a truck or, how shippers think or all sorts of things. So I think there's a lot more information available today than we've ever seen before.
I want to add on that as well if I
Thomas.
can.
Yeah.
I went from when I started in trucking in 2014, I was happy to find a Transport Topics magazine that was a quarter out of date when I was a frontline fleet manager. And I'd look at that and you'd hoard it like you could because the information space wasn't there. It's tribal knowledge. You had to pay your dues. I ended up doing 5 different positions in 5 years because I wanted to learn. And then starting at FreightWaves and what DAT, what Arrive's doing, every company now is providing free intelligence. We have decision makers and people being the information space, even for drivers. I am shocked by the TikTok, YouTube, the driver community, and they're giving tips away that, like Dean said, took 20 years of trial and error. So here's the app. You've got the app on the phone. You can see the whole market. Now you listen to your podcast while you're driving 11 hours each day, and you're gaining more information in a period of months than what typically used to take years before this kind of explosion in availability.
So Thomas, on top of that, well, I want to talk about so the availability of information, could that also help kind of flip the market quicker and more violently?
Interesting.
Well,
yeah, completely.
I've heard this is like the most anticipated freight market flip of all time, right? Because we're all just sitting here talking about when it's going to come and that kind of thing. And it's got everyone on the edge of the seat. And I'm sure when we see a pickup here with DOT week, it's going to be the same conversation. Are we there? Is this it? And so a little bit of mob mentality is unhealthy. So you really got to be cautious about how you use the intel, and that's kind of what we're advising.
Right. Hey, Thomas mentioned something interesting, and it has to do with technology and shippers and what David's seeing. I remember when I was at FreightWaves, I did a workshop for a whole group of shippers at a conference in Philadelphia. And I did the whole presentation with, tender rejections and tender volume and all the different things we'd present. And the shippers to a shipper said, that doesn't sound like the freight market that we're in. And of course, it was always back in 17, 18 period. I felt like shippers were always the last to know. Well, fast forward to 2024, and shippers can look at their lane spend by equipment type against their peers and figure out where they're underbuying or overbuying today when they go out to the market. So in that period of time, shippers have a lot more information. Also, I'm just wondering, David, you must be coming up against that when you're negotiating your bids.
Yeah, and even my role, right, over the last, I mean, we've been doing this at Arrive really publicly since, just before the pandemic. It was kind of good timing to be prepared to produce this content. And, even when I started talking to customers, it was, oh, they're so heavily reliant on, the monthly content we were putting out because they don't have access to all this info. Obviously, just, speaking to what you guys have all noticed too, the increased expansion of access to this intel and information. And now the conversations are much more of not an educational conversation, but a touch point on, hey, is this what you are seeing or feeling? Does this match up with, the data that you're seeing? And it becomes more of a checks and balances discussion and an educational discussion. Certainly at this point of where we are in the cycle, sort of waiting for that upturn. I think that's where I think of is really how the topic of conversation has changed. And over the years here is it's much more a checkpoint than an information.
Do we feel like the shipping community is a little bit more educated and or willing to be educated by things now versus before the pandemic?
I think so. They got burned. I mean, you got to imagine a shipper, you go, and that's the hardest thing to explain people when they want these answers. They want this. When is it going to change? When's it exactly? We're looking at like 3+ years of data where this whipsaw happened, where, you almost get this trauma if you're a shipper, where that's why looking at contracted rates, we look at the data sets, like we hear that they're down about 7% year over year initial contracted data. But at the same time, like there's this hesitancy, but there's a lot of noise. And I think that kind of builds into two things. One, there's tons of noise on the back end of the data. We have to go back to 17 and 18, leading into 19, and try to think that if it'll look like this when things have fundamentally changed. And then the second thing is we talked about all this technology and influencers. Now there's all of this noise added into the equation. So I theorize, and I'm curious what your thoughts are as well, is that this could theoretically speed up the destruction because it could reach an inflection point where the noise gets so much that we see the mass exit. So it's either going to be like a binary, a 0 or 1. It either like goes out with a bang or a whimper, just because of how you have all this wealth of data, but then there's too much noise clouding the decision making. We won't really know. I'll joke, we won't know until about a month later when it becomes painfully obvious what's going on.
Dean, what day? So Thomas made a great point here about we have almost an abundance of information. We went from no information to almost too much information. What are the key data points you're looking for and looking at right now to navigate this?
Yeah, I'm watching really carefully on the demand side. A couple of things is just the tonnage and the shipments of produce, and are the produce markets, the 20 markets where we get most of our volume, in track online with where they would normally be this time of the year, adjusting for last year's weather impacts, and how much they look like 2019, because we're about on produce, we're about 4% lower than 2019 volumes for middle of May. So that's kind of alarming in and of itself, because our spot market rates are kind of almost identical to 2019 levels, but costs are up 16 to 20 cents a mile to run a truck in the market.
True.
So that's one data point I'm watching, because as you and I have talked about a lot, Zach, produce market lifts dry van and reefer rates. It's right through July 4. That's in a bad year, you might see a 10 cent per mile lift. In a great year, it's like 25 cents a mile lift between April and sort of July 4. That's one thing I'm watching, because that kind of tells me how the rest of the year pans out. Because as you've always said, this is the quarter where you would normally expect to be making pretty good money as a carrier. The other data point beyond my normal sort of watching where operating costs are and gross profit margins of a typical owner operator at a losing 8 cents a mile right now. That's exactly where it was in May of 2019. So that's when you look at all operating costs and where rates are, and 15,000 empty miles and 100,000 loaded miles. They're losing money right now, which is what they did in 2019. The difference, 2019, you remember we had all those massive bankruptcies. We're not seeing that at that scale. It doesn't mean it won't happen, because I think interest rates are going to have a really big bearing on debt levels. especially overdrafts. So that's the other one I'm watching to get to the answer is the revocations. Now, as noisy and unreliable as FMCSA data is, directionally it tells you something. And we know that most of the new entrants that come in end up as DAT customers because we can track that. It's a logical place to start is the spot market. And we know that on the way out, when they revoke their authority, the vast majority are also our ex-customers, but they're also less than 10 trucks, like 75% of the revocations are owner-operators, which follows that those that joined it was a similar proportion, right? So I'm looking for the rate of carriers coming in and coming out. We're still seeing for every 10 that leave, 8 join.
Right.
The thing that's kind of a little bit shocking is that there's still so many joining because used truck prices are 20% lower, and because there's been a flood of large fleet sales and bankruptcies, which are sort of auctions. I'm inferring that a truck going to auction is a bankruptcy, and a lot of them are, but a lot of fleet leasing companies have been sending trucks to auctions, which sort of points to an underlying default in the loan. Because there's so much volume of trucks on the market, prices have come way down, which makes it easier to get into the market. So your used truck now, your average used truck at 5 years and about 490,000 miles, a little bit of warranty left is 20% lower than this time last year. So truck affordability is a catalyst for people joining the market in a market that you wouldn't think would be viable.
So I want to jump on that too, because are we seeing any? We talked about cost increases. Now, the used truck is obviously one that's come back down.
Right.
But what about the rest of the cost? Are we seeing any like potential increasing barriers to entry or something like that might actually prohibit this in the future?
Yeah, I think insurance capacity is decreasing. Like a hard insurance market will force the new entrant rates up. Not all states underwrite new entrants, as we've seen to the market. $25,000 to $30,000 per powered unit wasn't unusual during the pandemic. I don't know that you'll see those sorts of rates, but I don't think you can say that, I'm like a $10,000 per power unit on my truck and I've got no accidents in 5 years. But I think others that come in with a clean record, if you've got no accident history, you're still going to pay double that for a truck. So I think the barriers to entry are mostly going to be on the insurance side, in particular, and of course the used truck price. But I think, Zach, the big thing where people are getting caught right now is they bought a lot of older trucks post emission. God, I got to get this right because I have a pre-emission truck for a specific reason. The post-emission trucks don't last as long. They run hotter and they have much higher maintenance costs. So if you paid triple for a used truck during the pandemic, when you got caught on the back end of that doubling and tripling of used truck prices, and you've now got a truck that's worth a third of what you're trying to finance, and you've got much higher operating costs, that's where carriers are really getting squeezed right now, is on the higher operating cost piece. Not to mention the inflation effect on tires and fuel and filters and grease and things like that.
Yeah, I mean, obviously, we hear about the insurance costs inflating, and especially on this. Do you think that it's a little bit more polarizing for the smaller operator versus the larger one?
Yeah, I do. I think your loss history. It depends on how savvy the underwriters are. If they're using ELD data to underwrite you. Like, I think the savvy underwriters are using technology and data to carve out individual risk. It's called portfolio segmentation. It's where you carve out a carrier from a whole portfolio of dry van carriers. The smart carriers know how to do that. There's only a few that underwrite through the website using data to actually underwrite an individual carrier. Most carriers are going to get underwritten as a portfolio of auto haulers or reefer carriers. And of course, the good carriers get penalized for the ones that have had the high losses. So I've always found it better for carriers to go shop around and find someone who can underwrite them as a risk, as opposed to as part of a broader portfolio.
I've seen that as well. If I could hop in on the telematics, there's that fascinating thing we are seeing when I went to some conferences was that telematics providers are also saying we can help you lower insurance costs. And they're giving like, that was a big deal for them. Customer testimonials, if you had like 1,000 power units, we only use like 500 of them, whether it's construction or all across of it. So we are seeing this situation where the haves and the have-nots who use the tech, those savvy carriers who can show the ELD data and the actual stuff, share more with the insurers who are happy to get more data because they don't always get great data, are going to reap better benefits than like smaller, less tech-savvy fleets who may not have that capability yet. So I've seen that because it used to be large carriers were self-insured to an extent. They had insurance, but we are seeing a bigger trend. We're trying to do more with less. We want to share all this data in exchange for lower rates because that's a big thing to watch. And then EPA, you're talking about running hotter pre-emissions trucks. We have, and this is where I don't know, there's a big question mark coming up. From what I'm seeing, there may be a scramble, there may not be, of the year model 2027s. We have this weird looming phase 3 rollout that's going to change. And then, you know, how will that dynamic play out as well? There's a lot of things on the horizon.
Yeah, some people collect art. I collect pre-emission Caterpillar engines because they're an incredibly good investment.
Of course you do. Thomas, we got a question that actually is pertinent to this for you specifically. When do you anticipate large fleets putting in those pre-orders ahead of the 2027 regs?
I mean, we're going to see for those large fleets, we'll listen to the earnings calls. I don't think they're going to do it yet. You typically set your year CapEx. You decide to every quarter buy X amount, or you have your plans. I think that probably in 2026 or late 2025, we may start to hear it. It's a wait and see approach, just like with EVs. We have these EPA guidelines, but we do have a new administration potential. We have the old administration. It's an election year. If I'm a large fleet right now, I've got all this Fed drama, I've got all this econ drama, I'm probably going to put that on the back burner a little bit and see, because we do have situations where, depending upon the administrators within the government agencies, there could be a shakeup or there could not be. It just depends, because we've also seen situations where California and other states who are typically very green will move the goalpost as well. So a lot of people will fearmonger saying California is going to run trucking, but a lot of times you'll see in these states they want to take point for the bragging rights, but then when the reality sets in, they'll say, let's make a few little bit adjustments. So keep an eye on that, because it's really a wait and see approach from what I've read.
Yeah, and I want to remind the audience, we'll pause here at the end for some Q&A, but I want to get to this question. I'm going to pose this one to you, David, because we've heard Dean and Thomas talk recently, but I want to get your take here on the market dynamics and this erratic, volatile cycle. Now, I know people are going to say COVID was a black swan. I remember people saying 2018 was a black swan. Are we in a new era of volatility in terms of transportation market dynamics, where this is actually more the norm versus where we were coming out of that Great Recession, where we could almost set our clocks by produce seasons and all these seasonal things, myself included, where we're kind of like lulled into this false sense of security? Are we now in a new era where volatility and this layer of unpredictability is more the norm?
It's hard to say. I definitely think we've seen a regression back towards more normal seasonal patterns, particularly the back half of last year, into the first half of this year. You're seeing rates pop when you expect them to pop. Van reefer in the areas where you expect to see them, right? As those produce and harvest seasons move around the country. And we saw really normal seasonal patterns over the past, better part of the last year. So, I think that cycle is still here, and that's going to be here to stay. I think, it's unlikely that we see as volatile of an upswing as we did with COVID, and certainly something, we're of the belief that, the duration of these events is going to be shorter. We think, especially with the amount of capacity that's available right now on the road, the equipment that's not being utilized, the ability to ramp up supply to meet demand, any kind of demand, fluctuation in that regard should be relatively quick. I talked about the shipper technologies earlier that I think help them create healthy competition and, in the spot market that, should push rates down pretty quickly, as that supply becomes available to them. I think all of these things right now are certainly in the short to midterm range implications for us. The long-term regulation stuff that you guys were just mentioning, all fuels, EV, that's certainly a variable that has the potential to be on the magnitude of COVID or greater of a disruption, especially as we get closer to 2030. We think about market disruptions in a sense of, we use the term vulnerability, right? Some of the metrics you guys, that we are watching, obviously, spot to contract rate, rate spread, right? Right now it being, yes, greatly reduced from right now greatly reduced from where it was earlier in the cycle, but still near all-time highs, right? So what type of event would be required to cause spot rates to become at a national average more attractive than contract? A big one right now, right? So we think about vulnerability and how imminent these things are. What types of events or black swans could cause a disruption, rather than trying to predict when they'll happen. As we see that gap close, as we see a little bit more sensitivity and tender rejections around these seasonal events, then we'll start thinking less of a size of event to create that disruption. We try and think of it in a little more pragmatic way like that.
So how vulnerable do you think the market is now? And what are you using to kind of validate that?
Yeah, like I said, I think the spot to contract rate spread, being, depending on which index you're looking at, I know both DAT and Freightways have their own.
Sure.
Like I said, it's still really historically high today. So like I said, pretty low vulnerability to a sustained routing guide disruption right now, into my mind. I think especially when you look at the way that carriers have not allowed, they haven't really failed on their commitments, to contractually, right? You look at that tender rejection data through these bouts of seasonality. Yes, they spike a bit, but we're not talking about, especially on the van side, 10, 15, 20% rejections. Haven't seen anything close to that, right? And so, historically, when rejection rates get over 10%, then you start getting to that point where, yes, that demand is moving to the spot market. That's going to really challenge things. And when you see that spot contract delta, in that 20 cent or less range, I think we're really a lot more vulnerable to disruption.
So we had a question come in, and I love this question, and I'm going to pose it to you, Dean, because you're the one with the most experience on the panel here. So with the whiplash of the last 4 years, what are the lessons that should be keyed in on to minimize the extremes of high and low in the next cycle? And I think you can answer this from multiple perspectives,
Right.
but I think this is a good question, and I want to hear from all three on this one.
Yeah, so from a carrier's perspective, big lessons learned. You really got to understand your operating costs. Got to have a good mix of spot and contract freight. You got to have really deep relationships with your brokers, your 3PLs. But transparency is really important. I'm always, get frustrated by this whole transparency debate and floor prices in rates and all this stuff. And because carriers can't have transparency on the way down and then not have it on the way up. Like, you've got to be transparent about what it costs to run a truck. You've got to be a good negotiator, but you've really got to have really good partnerships. And I think that's the theme that's different. That's the lesson I've learned from shippers, right? Because shippers had maybe 6 quarters of double-digit rate increases. We've now just seen the opposite on the way down, even though rate decreases on RFPs are sort of in the low single-digit range now, as opposed to nearly double digits all the way down last year. I think there's a lot more. The lessons learned we hear from shippers is building better relationships with their capacity providers, whether they be non-asset or asset-based. So relationships are really important. I do hope, this is maybe wishful thinking, that carriers have understood the need to understand their operating costs a lot more. We encourage them to put their operating costs into their load board apps so they can figure out, is a lane profitable. It's not a definite science, but at least it gets them thinking about what it costs to run a truck, to avoid the mistake of coming into the market cycle and thinking these good times are going to last forever, which of course they don't.
Thomas, what do you think? You think this is a situation that we can kind of smooth out?
I think adding the points, one, you got to be a good operator, looking ahead, looking at 4 years worth of things. I was in the middle of that market at a startup, and I think that, one extra thing I want to add additional, because I think Dean covered a lot of good stuff. As your fleet gets larger, I think this is the important thing. Watch out for the growing pains, understand your technology, try to integrate as much as you can, but also know what you're good at. It's almost like we look at all this data, when you're transitioning from a pure play spot market situation to get your first contracts with customers and stuff, trying to find that out is just as much an art as it is a science. And so I think that's an important thing. Try to cut through the noise and find your signal. If I have a carrier in Dallas and then one in Minneapolis, they're going to behave very differently no matter what. So I think that the biggest thing from taking 4 years worth of data is recognizing that there's been a lot of changes. But if you're a seasoned operator, you've been doing this 10 or 20 years, know what you're good at and be very selective and choosy, because there's a lot more stuff now we can use to integrate our technology. So I think that that's probably the biggest takeaway, is that for carriers who want to succeed moving forward, you have to get out of your comfort zone. You have to look at adding more of this new tech and start getting the same kind of benefits that the large carriers had for decades: routing guides, EDIs, APIs, thousands of trucks tracked, it's being shared, automatic tenders. So, keep an eye out for the new stuff while also retaining what works in the old, because the ones who do too much, too little, you have you're balancing. So just be very careful on how you do your weights.
Right. David, let's hear it, man. Can balance be maintained?
No, I don't. I think the answer is no. You hear everything here, right? These are all great points that individual contributors or participants in the market can do to provide more balance to their world. And I think that that's definitely something. There are a lot of lessons to be learned from these cycles that these companies should take to heart, particularly on the carrier side. But you're seeing it. Look at Q1 anecdotes. Shippers are, chasing the rates, right? And a lot of times it's not transportation people who are coming down with these initiatives. It's finance departments, et cetera, at these organizations, people that aren't necessarily in the know. They don't have, that expertise of what we're talking about here in the freight market. They're always going to chase those dollars, right? And carriers are going to keep chasing that money, right, too. And that's what's going to happen. The industry is way too fragmented for everyone to move together. And we're going to continue to see, market cycles for sure. It doesn't mean, we're not advocating for better operating practices. We certainly are. But I think it's going to be hard for the market to move as a whole.
Is there anything that, from shipper carrier broker perspective, that we can take away from all this volatility that will help us navigate it? That's to all three of you. Whoever wants to chime in.
I think I got one as well with brokers. I see it a lot in the trucking community. Frenemies, the circles of hate. The carrier's mad at the shipper, who's mad at the broker, who's mad at the carrier, and vice versa. The technology is allowing it to where we probably need to put aside some of the memes that we keep seeing of, I'm getting shafted, vice versa, this antagonistic thing. I think right now we need to recognize that everyone has a place. A brokerage operates in a specific place that needs carriers. Carriers also need brokers if you're trying to route back to your main shipper. Shippers want brokers because they fill a gap in the routing guide, that I don't want to be the transportation manager who gets wrote up and no bonus because half of my routing guide has failed for lanes under 10 a year, which we see that stuff. So I think that's the biggest thing I want to see, is that we have all this tech, we have this visibility, but let's all try to be a little nicer to each other moving forward, because each one operates it. But with the technology, we're all getting so much better that there's a potential to see bigger oscillations, and we have to be prepared for that and start, valuing the relationships.
Yeah, I agree with that.
You got anything to add, Dean, to that one?
No,
I think there's it's a free market, so we're kind of bound to that.
Yeah, I just think that's what, I'll speak for carriers. They need to understand it is a free market. You can't sort of complain about where rates are, because rates were triple what they were a few years ago. So that's what a free market is. You can join, the great American dream, right? You can buy a truck and start your own business and be an independent contractor. You just got to know what you're doing. And I think what we've seen is there are a lot of opportunists in the last 4 years that just jumped in. I don't know with any intention of ever staying in the market for a long time. And that did a lot of damage, right? That drove up truck prices, rates went up, we moved a lot of stuff, we sat on loading docks for a long time, incredible disruptions in the supply chain. But eventually that capacity left the industry and left its mark on a lot of us, because we're all sort of suffering from that now in terms of the reputational damage that we've had to endure as carriers.
Yeah, we got a question that came in that's kind of on top of this. Historically, the freight industry seems to have an inherent trust and commitment problem. And I think that works both ways.
Yep.
So how is true collaboration even possible when this mindset remains pervasive? I'll
Yeah.
open that up to anybody that wants to tackle that one.
Yeah.
I mean, I guess I would just say I'd go back to, Thomas was mentioning this, relationships continue to matter. They really do. And we've continued to find, service and relationships and, the more you can prove over time, and through these cycles, you're worth your words. I think that's the type of thing that you can do, but these are individual battles, right? I think, it's hard. It's going to be hard for these things to permeate through the entire market. The good players are going to be good players. They're going to be rewarded for the service they're providing. And they're the ones that are going to last.
Sure. So I
I
have one
think
more question. Go ahead,
adding on
Tommy.
that, technology is bifurcating the 80-20. Find that good 20%, that's 80% on top, making sure you're going to have to try harder. So to fix some of these trust issues, it will take more work, but at the same time, once you find it, recognize it and utilize it, because there's a lot of working at a large asset-based carrier. Our service levels are really bad. So if you find the ones that are good with the technology, stick with the ones that are good, but it's harder. Just like with the tenderization of freight, I'm calling it. It's so hard to find a good partner these days, but when you do find one, stay with it.
So staying with you, Thomas, for the last question, I think this will probably be all we have time for. Can you share more about where JB Hunt aired with container purchasing?
Mike Bowdendistel had such a great talk. I had him on my podcast earlier. Read some of the stuff. He wrote an article that we did on FreightWaves, but the challenge was when we look at all container data on intermodal, sometimes executives think that, oh, this is good, we're going to get more share. But then Mike highlighted that you have to break it down. So the boats that were bringing them in and going on the port, it wouldn't go on the rail for like the smaller ones the carriers would like to use. It stayed on the 40-foot. So the 40-foot got shipped everywhere because they weren't worried about losing their stuff. And then the JB Hunt really loves the 53-foot because then they transfer it over and they use it through their stuff. So when you look at their earnings calls Q1, it was like, kind of meh for the domestic. But we saw that bump in the international, and you can get bit if you look at the data a wrong way or make the wrong conclusion.
Yeah, not reading or understanding the context. Super important.
There's plenty of data, but if you can still make mistakes with visibility.
You can misread it. You can misread it. Last question. I may pose this to all of you. Dean Croak, when's the market going to show an inflection?
That's the ultimate reputation trashing question. Right. Yeah.
I told you mine November 8th. I put myself out there. Do we think it's gonna happen in the next year?
In the next year, yes. Yes. I don't honestly, this year just is shaping up as kind of that, just like a slack tide. It's just sort of nothing's happening. I'm not seeing any signals that would be putting more freight on the back of trucks, other than some seasonality around some of the things that we normally see. Produce season will be some lifts in some regional markets. Shipping season around October will be probably pretty good this year. But I don't know that structurally we'll see a change until next year, largely because of where I started the show is with this capacity that has this incredible ability to hang in there. It can withstand a very soft market more so than any other freight cycle.
David, you got a date circled on your calendar?
No, I mean, I'd say again, that vulnerability conversation, right? When is that likely to be the case? I think it's possible, if we can continue to get some contract rate cuts over the next, 6 to 9 months. And we had, like what we saw earlier in this year with that winter weather in January, right? I think I'd be looking to Q1 as the first potential, right, to see something like winter weather, after we see spot and contract rates converge a little bit more, and a little bit more capacity exit the market, as a potential point where we could see, sustained disruption, go back to polar vortex, what was that, 2014, something like that, right? But otherwise I'd be looking more to the midpoint, this time, next year as really primed for, a shakeup.
Good deal. All right, Jacob, I think I ran us up to the end. Take us home.
All right. Well, thank you all for participating, and thank you to all of our attendees for listening in and providing us with some great questions. I hope you learned some valuable insights today. And as I mentioned in the chat, we'll send out a copy of the webinar to everyone who registered within 24 hours. So thank you all for joining us, and look forward to seeing you on the other side of the market. All right.
Thanks, guys.
Thank you.
Everybody.
Bye.